Hello, I'm Tony Marino, President and CEO of Tenaz Energy. Thank you for joining us for our Q4 and year-end 2022 results and reserve update. Before we get started, we ask that you please note our advisories on forward-looking statements. First of all, production was up substantially in Q4 versus Q3 and the year earlier period. This was driven really by the drilling program that we conducted on our Leduc Woodbend assets, and I'll come back to that later on, and with a very small contribution from closing our Netherlands acquisition prior to the end of the year. Operating netback was up substantially as well, and this was primarily driven by an improvement in prices and lower royalties quarter-over-quarter. Funds from operations was up substantially, driven by the production increase and the higher netback. Net income was down a little bit year-over-year, about $3 million year-over-year. This was really driven by non-cash impairment reversals that occurred last year, exceeding those that we took earlier this year. Net income was actually up slightly in Q4 as compared to Q3 22. In our development project at Leduc Woodbend, during the quarter, we drilled, completed, and tied in 2 additional Rex wells, bringing our total number of wells drilled, completed, and tied in to 4 for 2022 as a whole. We made substantial improvements, we believe, in the way that we're drilling these wells. It starts with an improved geologic and reservoir description that allows us to put the wellbore within the net pay zone over a greater distance, allowing us to drill longer wells, which we believe are more capital efficient. In addition to that, we changed our frac designs, which gave us a higher percentage of frac placement. We're essentially up to about 100% frac placement of what we intend to do in the last few wells that we drilled. Overall, this gives us better long-term production rates and better capital efficiency, and that's one of the drivers of the reserve results that I'm going to talk about later on. On the financial side, we continued our stock buyback or NCIB program. We've now retired about 700,000 shares since we began that program in the summer at an average price of $1.88 per share. Our balance sheet, in our view, remains very strong. We had $14 million of net working capital at the end of the year. That is up slightly from Q3, despite making the Netherlands acquisition and doing this drilling in Leduc Woodbend. So a set of financial results and production results that we're quite happy with for Q4. Next, let's move to our update on a reserve position as evaluated by McDaniel & Associates. We put out what we feel is a strong set of reserve numbers, with overall 2P reserves up 20% year-over-year. This was driven by a substantial increase in reserves in our organic Leduc Woodbend project and the contribution of the Netherlands acquisition that we closed before the end of the year. Overall, this means that we replaced over 600% of production at the proved plus probable level. We had a substantial increase in estimated after-tax net present value discounted at 10%, nearly a doubling for the corporation as a whole. That reflected improvement in Leduc Woodbend and also the addition of the Netherlands reserves. This improvement in NPV is driven by a higher price deck based on the average of the 3 engineering consultants' price forecasts that we use in our reserves, and the additional volumes and improved capital efficiencies as a result of our program and in the positive contribution from the Netherlands assets. This results in quite a strong recycle ratio. This is the amount of operating profit that we generate per dollar invested. At the 2P level, including changes in future development capital, we recorded a recycle ratio of about 4.4 times. $4.4 of estimated operating profit for each dollar invested. And at the bottom of the slide in the table, and as reflected in our press release and year-end documents, we show the detail of our reserve statistics for each of the reserve categories, starting with PDP, and then at the total proved and the total proved plus probable levels. So our 2023 outlook. At Leduc Woodbend, we're going to continue our development program. As we did in 2022, we'll drill 4 gross. For this year, it will be 3.35 net wells. That activity will occur after breakup, with the drilling beginning in the summer, and we would expect to have those wells tied in the second half of the year. In addition to the drilling in Leduc Woodbend, we'll make some minor facility optimizations that should allow us to produce at higher rates in the future as we continue the development drilling in future years. With continued production growth in the field, we should be able to achieve economies of scale that will allow us to reduce the unit costs. In our non-operated Netherlands asset, the operator intends to conduct some workover and optimization activities on the existing well base that should allow us to continue the current production profile. There is some potential that additional drilling activity could occur on the Netherlands licenses later in 2023. If that activity occurs, we'll adjust our budget at that time. And finally, of course, we'll continue the disciplined M&A efforts that are the main part of our strategy to attempt to add additional assets and value for our shareholder base in our primary identified regions of focus, Europe and MENA, but also with the potential to make transactions in the Americas. On the lower left, we show our production mix that we expect for 2023, assuming there are no further acquisitions. That would be 44% liquids production, oil and liquids, about 1/4 North American gas, and about 1/3 contribution from the existing asset set in high value and high margin European gas, shown here with the TTF marker. On the lower right, we show our combined guidance for Canada and the existing Netherlands asset, production guidance of 2,200 to 2,300 BOED. That's composed about 2/3 of Canadian production and 1/3 from the Netherlands asset. Combined E&D CapEx would be 20 to 24 million, as we've currently identified the program, with the identified drilling activity, as I mentioned before, 4 gross, 3.35 net wells in Canada. Let's put that 2023 outlook in the context of Tenaz Growth history. We effected our recapitalization of Altura Energy in 2021. We announced the recap in Q3 21, closed it in the early part of Q4. Production has more than doubled since the time of the recap as projected for 2023. We've had an increase in reserves as shown on the upper right panel in this slide. And looking at the lower left, even through the 2022 results, we've had a substantial increase in FFO, or funds flow from operations. Using our forecast for production for 2023 and the current commodity strip, we'd have an even greater increase in FFO during 2023, and that includes the impact of the Netherlands acquisition for a full year. So we have had good growth in this company in production, reserves, and FFO. I'll point you to the capitalization table we have on the lower right. Currently, Tenaz has a market value of equity of about $60 million Canadian. After deducting off the $14 million of positive net working capital at year end, we would have a EV of approximately $45 million Canadian. And we do show on this slide as well the insider ownership, meaning the management and board of directors, showing substantial alignment with the shareholders of the company. So now let me summarize the Tenaz model. We're a public company traded on the TSX, symbol TMZ. The primary focus of the company is to make international acquisitions, primarily in the Europe and MENA regions, although we have optionality for the Americas as well, and to take those assets and improve their performance over time through our operating capabilities. We have an existing desirable Canadian oil growth project. It is now paired with European natural gas production through the Netherlands acquisition that we made. And we would seek to grow the Canadian asset and do additional acquisitions in the future. From a balance sheet perspective, the company is debt-free with positive net working capital and projected free cash flow from the existing asset base to give us the wherewithal, along with what we believe is demonstrated access to the capital markets, to make additional acquisitions in the future. We believe that our management has a record of value creation running this model of M&A followed by operational improvement, and we intend over the long term to translate that into a growth and income model for our shareholders. So thank you for your attention today. We look forward to the next time that we chat, at the time that we will release our Q1 2023 results expected in May of this year. Again, thank you from Tenaz Energy.